Good evening, everyone. I'm Laurent Deville, professor of finance at EDHEC Business School, and tonight I will be hosting the last episode of the EDHEC Business School Future of Finance Speaker Series of the 2025-2026 season with our guest speaker, Professor Ayako Yasuda, who is Maurice and Marcia Gallagher Chair, Professor of Finance at the Graduate School of Management of the University of California in Davis. Tonight, she will question the capacity of mutual funds to align objectives and action when it comes to sustainable investment. But before we start, I would like to briefly introduce Professor Ayako Yasuda. After a short period in the financial industry, she completed a PhD at Stanford University in 2001, and since then has become a leading scholar in the fields of venture capital and private equity, of entrepreneurial finance, and of particular interest today in sustainable and responsible finance. She holds permanent or visiting positions at the Wharton School of Business, at the Haas School of Business, and currently at the Graduate School of Management of the University of California in Davis. Over these years, she published influential papers in her fields of research in leading journals. I think it's important to mention that she wrote a book with Andrew Metrick on venture capital and the finance of innovation, since, well, people are publishing less and less books, and we need those, I think. So I wanted really to emphasize that effort. And she received multiple honors and distinctions. One I would like to cite is the Moscovitz Prize for Socially Responsible Investing for her article co-written with Brad Barber and Ada Morse in the Journal of Financial Economics on impact investing. Today, she is going to talk about sustainable investment from the perspective of intermediaries. The results of the paper, Decoding Sustainable Investment Strategies, Bridging Intentions and Outcomes, may or may not surprise you depending on your stance regarding what the industry wants to do or claim it's doing, and what it effectively does, or the effect on the real economy it may effectively have. So after your talk, Ayako will have the chance to start discussion with Professor Sophie Clot from EDHEC Business School and director of the MSc in Climate Change and Sustainable Finance, and Theo Jesover, one of our smartest and most engaged students from this program. For the audience, do not hesitate to share your thoughts, write questions within the Q&A. I will be able to route the questions to Ayako at the end of the talk. And now, Ayako, without further ado, the floor is yours for the next 30 to 35 minutes. Thank you very much.
Thank you, Lauren, and thank you, Sophie, and everyone. Thank you for the very kind invitation. I'm very happy to talk to you today about sustainability objectives of mutual fund managers in the US. So let me start by sharing my slides. Let me know if you can see. Okay. All right. So let's begin. So sustainable investing has grown very rapidly, which is the good news. But the label sustainable really pulls financial, moral, and impact objectives. I'm going to define them in the next slide. And these objectives implied quite different predictions about portfolio holdings, stewardship of the funds, and the real world outcomes of their holdings. So in order for us to assess what is the promise and limits of sustainable investing, we need to know which objective funds actually pursue. We also know from prior research that real-world impact from investing sustainably through capital markets requires genuinely impact-oriented funds and also investors willing to bear the trade-offs. And existing labels don't really cleanly distinguish between these goals. So what I mean by those three goals, I present these three archetypes of three investors. So first one is Ellen. Ellen says, I sense a huge shift in the economy towards decarbonization. I want to climate-proof my portfolio against stranded asset and various other related risks. So this element represents a financial objective of investors to integrate sustainability when it is financially material for risk and return. So the goal is still traditional financial goal. Now its sustainability is an additional input. Sam says, I object to private prisons, and it bothers my conscience if a mutual fund I hold invests in a private prison operator. Sam is expressing a moral objective. He wants to avoid holdings that conflict with investors' values. Finally, Inger says, I care deeply about expanding access to clean water, and I want to use my capital to back companies that can help make it happen. Inger is expressing an impact objective. She wants to seek real-world, either environmental or social improvement through invested firms. These goals can imply different actions. For example, from a financial objective point of view, it's rational to avoid ESG-related risks by holding firms that are already positioned for transition or already green. Whereas from an impact objective, it makes sense to hold firms which has scope for improvement. So they're still brown and they could turn more green, and to use ownership to influence the outcomes. So that means the same brown firm may be unattractive for a financial sustainable investor, but attractive for an impact sustainable investor. Moral objectives sit sort of outside of this dichotomy. They want to exclude firms that are engaged in objectionable objectives, activities, independent of financial upside or scope for improvement, the additive improvement. So given this distinction, the research questions that we wanted to ask in this paper is, how prevalent are financial, moral, and impact objectives among the sustainable funds? And how do these objectives actually map into what the funds do? So portfolio allocation, voting on shareholder proposals, and so forth. And finally, are they associated with actual real-world outcomes? If you remember one slide from today's talk, I want you to remember this pie chart. So this pie chart shows the breakdown of sustainable funds that we identified. And it shows that 88% of all assets under management, these are US mutual funds, are financial. We identify about 1,500 sustainable funds that are managing $1.7 trillion as of 2023. 88% are financial funds. They hold high ESG, low carbon portfolios. That's consistent with their goal of ESG integration. 10% are managed by moral funds. They exclude sin and brown sectors. They seem to enjoy lower flow performance sensitivity, which is consistent with them having a match. They're matched with investors who are willing to be more tolerant of financial performance, be not top notch. And finally, only 2% are managed by impact funds. And we find that impact funds do hold browner firms. They are more activist, and they are the only category linked to emissions improvement. So they're small in AUM, despite I think that maybe the surprise that you find here is that there is a prominent impact rhetoric in sustainable investing, but we find only 2%, very small amount of AUM is actually committed to that goal. How we go about doing this, the operation of this paper, we use some machine learning method called BERT model. So we start with one section of the US fund prospectus called Principal Strategy section. And from here, we extract sentences that have ESG keywords. We manually code a portion of this, about 3,500 sentences, into these three goals: financial, moral, and impact. And some sentences are not classifiable, they're too vague. And then we use these sentences that are manually coded. These are sort of ground truth as both training sample to train BERT model, which is a pre-trained natural language processing model, and as also as a testing sample to make sure that the trained BERT model can function very well to classify sentences. And once the model is performing well, we check that the accuracy is over 90% at the sentence level. Once the model is validated, we use this model to classify all the sentences in the universe of mutual funds in the US for the last 10 years. Just to give you some examples of the sentence that we classify. So just to give you this sentence: the advisor evaluates financially material ESG factors as part of the investment decision-making process for the fund. This is a classic financial sentence. The second one: the index excludes companies involved with weapons, tobacco, gambling, alcohol, adult entertainment, and nuclear power. This is a moral sentence. We will classify this as moral. And the third one: the fund will invest 80% of its net assets in the equity securities of companies that are identified as having or seeking to have a positive carbon impact. And the last one is an example of a sentence too vague to be classifiable. The fund seeks to achieve its investment objective while applying ESG methodology, but it doesn't describe what the methodology aims to do. So I hope that gives you a sense. Now, because everybody talks about AI every day, you might be wondering, why not use generative AI as the main classifier? We actually experimented with that, and here we compared the ChatGPT 5 performance with prompt instructions with fine-tuned BERT that we use in the paper, and we find that BERT has much higher precision, implying they have much fewer false positives than GPT. Possible reason for this is that Gen AI may inherit the fuzzier goal distinctions or confusion that's present in the public discourse because they're trained on the internet. And there's some research showing they are inheriting the human biases in these LLMs. So based on the better performance, we use BERT. So applying this methodology to the US mutual fund universe that we download from the SEC, we find that there is a huge growth in sustainable fund industry starting from 2014, where the sample begins. And in 2023, about 1,500 mutual funds are identified by our method, managing $1.7 trillion. And this is overwhelmingly financial: 88% financial, 10% moral, and 2% impact. Here you can see the dollar amount, and we try to do some robustness on, is impact really so tiny? Because everybody wants it to be bigger, right? So under our baseline methodology, impact funds account for only $29 billion. As an upper bound, we try to relax what can count as an impact fund as much as possible. So if they have at least one sentence that meets the criteria for impact, it goes up to $86 billion, or 5% of the total. So even under this definition, impact still remains a very small share, unfortunately, and financial remains dominant. Here we are looking at what really drives the annual change because, yeah, you can see that after the Paris Agreement, there is a rapid growth. And if you look at the existing funds versus new entrants, newly classified funds, the orange part in the left panel, they contribute meaningfully to the AUM growth. So there are funds often switching from being non-sustainable to becoming sustainable, but in a financial way. And when you look at the decomposition of the growth in the right-hand side panel, that's what we find, that the bulk of this entrance is not brand new fund, but rather the existing funds switching to becoming financial sustainable funds. Now, then the question is, do these classification shifts actually changing what they say in the stated objectives, or is it just that they're just generically talking more about ESG? Is it sort of a greenwashing in language? And we find that no, that's not true. When they reclassify as sustainable, they are meaningfully changing what they say in the prospectuses. So you can see that from being zero sentence, they are going to have, after the reclassification, 2 to 2.5 sentences that that are substantively talking about sustainability. So we generally don't find that the funds are not faking what they say they do. It's more that what they say they do is not actually generating impact. Instead, it's about risk management and enhancing financial performance by using ESG as an input. You might wonder, well, there are other vendors like Morningstar, MSCI. Why build your own classification? That's a good question. So one big reason why we are motivated to do this is that these classifications that are existing and provided by vendors to commercial users, they can treat similar financial language, financial sustainability language inconsistently. So for example, we find two Morgan Stanley funds. They use similarly clear financial sustainability language. Morningstar has a list of Morningstar has a list of sustainable funds. It lists one of the Morgan Stanley fund as being on this list, but not the other one. And the fund that's actually not on the list is a much bigger fund. So that's an example where our method will consistently classify both of them as sustainable. Now, that makes our classified sustainable fund sample bigger than, say, Morningstar. On the other side of the spectrum, everybody also likes to cite how much trillions of dollars of assets are managed by UNPRI signatory asset managers. Now, that figure substantially overstate actual sustainable AUM. For example, BlackRock, $2.2 trillion in US CRISP equity fund AUM. So CRISP is a US mutual fund database. And under that, they manage $2.2 trillion total. But our method only identifies about 52 billion of that 2.2 trillion as managed under sustainable strategy. So vast majority of BlackRock assets are still managed as non-sustainable, despite the impression that they are very sustainable. So we think that this is a meaningful method to add new knowledge to our understanding of how much sustainable capital is out there and what are they doing. Okay, let me now give you a little bit more descriptive statistics and then the results. We find that there are meaningfully different industry exposure among different funds. So for example, financial funds, it's a little hard to see here. Financial funds tilt towards tech and away from manufacturing. And whereas impact tilt away from tech and banking and finance and towards utilities and manufacturing. And moral funds act differently. They differ mainly through particular sin sector exclusions. And basically information is tech sector versus utilities. This is a very different industries. Tech has a much higher E rating. This is MSCI 8.0 versus 6.0 for utilities. And utilities has a much higher scope 1 and 2 intensity. So 39 for tech versus almost 2,000 for utilities. So utilities are 50 times more carbon intensive, and that's the sector impact funds tilt towards and financial funds tilt away from. You can see this more systematically here in carbon emission intensity of fund portfolios. We find that financial funds hold lower carbon portfolios than benchmark funds. And this is mostly driven by their tilt towards cleaner or lower carbon intensity sectors. Impact funds, on the other hand, hold more carbon-intensive portfolios than financial funds because they tilt towards dirtier or browner sectors. That's consistent with them wanting to hold sectors that have more room for improvement and then try to improve their emission by reducing it. We look at performance of these three separate categories of sustainable funds, as well as their flow performance sensitivity. Flow performance sensitivity is a measure that's used in finance research for a long time to measure investors' tolerance of, say, relatively poor performance. So if they are very sensitive to performance, as soon as the funds underperform, they would sell, there will be outflow. So it will be a high flow performance sensitivity. So here I'm just showing the key coefficient in a regression. There's a longer table in the full paper that you can download and check for more details. We find that moral funds has a lower flow performance sensitivity compared to benchmark funds. Whereas for financial funds and impact funds, while they're negative, they are never statistically significant across many specifications. So this means the clearest evidence of flow performance sensitivity that's lower is concentrated in moral funds. So if you think about investors who have this non-financial motivation, they want to be good, they want to support, or they want to be moral, those investors seem to be correctly matched to moral funds, but we don't find the same evidence for impact funds. And that's open to some different interpretations. We also look at fund managers and funds engagement with the portfolio companies, because one channel through which investors can impact the activities and real world outcomes of the firms is through voting on shareholder proposals on environmental and social issues. And here we find that compared to benchmark funds, all sustainable fund type support E and S proposals more than benchmark funds. So good, they all have higher support. Impact funds have the strongest support, overall 59%, relative to benchmark funds support of only 25% of the time they support yes. Now, financial and moral funds are somewhere in between. This pattern motivates a closer look at what kind of proposals they are supporting. Are they proposals that are proposing to change outcomes, or proposals that are, for example, calling for just more disclosure? Because more disclosure means more information for the investors, but not necessarily any change in what the firms are doing. So we separate the proposals between outcome-focused proposals, for example, eliminating harmful products and fossil fuels from operations, or implementing policies that promote worker welfare, safety, human rights standards. Now, these real-world outcomes are often costly, so it has a short-term negative financial impact on the company's bottom line. And so these outcome-focused proposals receive lower average support by investors, by shareholders, consistent with the higher cost. And impact funds disproportionately support those proposals that are aimed at achieving real outcomes. So here we see impact funds walking the talk, and other funds are doing what's consistent with their goals, but not something that promotes outcome changes. In the final segment here, we do directly look at outcomes, and we focus on emission intensity changes. We can look at the overall portfolio carbon intensity, as I showed you before, and we show that differences, but that doesn't really tell a clear story of, is there some kind of a effect that investors are having on the firm? So while isolating that absolutely cleanly is very difficult in the real world, we use something that is closer in spirit to that treatment called difference in difference design. And here we define a treatment. So treatment could be like a patient receives a drug, but here the treatment is when a firm is first purchased by an impact or financial or moral fund. And we have a control firm. So, patients who receive a placebo drug, here the control firms are never treated firms. They never receive this investment by any sustainable funds. And then we stack them and we do event study to see if the firms that receive sustainable capital of a particular kind, do we see change in their emission intensity after that treatment. So it's a dynamic effect model. And our hypothesis is that if impact funds are walking the talk, we should see carbon intensity going down after the purchase, but not before. And this timing is important because if it starts improving before the purchase, they could just be selecting firms that look like they're about to reduce intensity already. So just like cherry picking firms that are already making efforts is different from you generating the impact, right? So we pay attention to that timing, and we find that carbon intensity falls after impact fund purchases. So the left-hand side panel have all impact funds, and we are showing the scope 1 and 2 intensity. We look at 1 and 2 and 3 intensity as well. Results are very similar. And so we see that the firms are not reducing intensity before, so no pre-trend, and the intensity declines, and the effects become more significant around 7 to 10 months after the purchase. So that delay is actually it's meaningful and more consistent, because if you really want to change the operation of the firm, you can't do that just the moment that you buy the firm. It would take time. So actually the effect not showing up until later gives more support to the interpretation that impact funds are inducing change in the firm. We also note that not all impact funds are environmental, and we are looking at emissions. So there's no reason to predict that social impact funds improve emission. So in the right-hand side panel, we limit our analysis to environmentally focused impact funds, and the results become stronger. So that also gives us a support for this treatment effect or causal effect. We do the same analysis for financial and moral funds, And we don't find any pattern that is similar to impact funds. Here we are showing financial funds. This is a very surprising result. It looks like financial funds are selecting firms that are already reducing emissions before the purchase. So they are picking firms. But once they purchase the firm, emission doesn't improve. After the purchase, they start to actually go back up again. We thought that, well, the improvement before the purchase, it could be happening because the same company is simultaneously held by impact funds. So in the right-hand side panel, what we do is we remove those funds that are receiving simultaneous purchase investments from both financial funds and impact funds. And then the post-purchase improvement really disappears. So overall, this shows financial funds as not generating any positive impact and strengthens the interpretation that impact fund result is not just selection, but actually inducing change after their investment. Okay, so to wrap up, in this paper, we use machine learning on prospectus text, so text analysis, to classify sustainable mutual funds by their stated objective into financial, moral, or impact. We find while there is $1.7 trillion managed by sustainable funds in the US, most of that reflects financial intent. While impact-oriented funds, which may be the most important one from a policy objective, remain a very small share. We also find that fund behavior lines up very well with the stated objectives. They all do what they say they do. Moral funds show lower flow performance sensitivity, so they are matched with moral investors, looks like. While impact funds are the strongest supporters of outcome-focused E and S proposals, so they are actively supporting those proposals. Financial funds hold greener portfolios if you look at the level of emission, but importantly, only impact funds show evidence of changing firm outcomes. But because they manage such small share of the total financial capital that's available for sustainable funds, it does suggest that as long as this distribution that's very asymmetric doesn't change in the US, it's unlikely that sustainable investing can generate a large positive impact on the environment or on the social dimension. As disappointing this result may be, what I hope that this research generates is more research to find out why there is so much asymmetry and if there is any room for changing that, either through policy or through more clear labels or disclosure, so that investors who want impact may more easily be able to find those impact funds. So those are open questions that I hope that this paper motivates.
Thank you very much,
Thank you.
Ayako. That was really enlightening, and well, we have, I guess, multiple questions, and if I just say that impact funds have an impact, but they are so small that this impact may not prove very significant overall on the market, would that be correct with respect to what you found?
Yes, that would be inconsistent with what we find for US mutual funds.
Okay. I think so. As I understand it, and Sophie and Theo, I let you speak, but I always wanted to jump in. This is what they say they do, and so you say, well, they do what they say they do. And my question is, with respect to the current conditions, is it still safe for these funds to say that they do that, that they invest in sustainability? And wouldn't you think that we could have this kind of closed sustainable funds that do it without saying it because it becomes unprofitable in terms of attracting the flow or raising concern with respect to the administration of these kind of things? I guess that your sample ends 2023, and so that this kind of impact may be seen later on, but what is your stance on this kind of possibility?
So you're, I think, asking fund manager incentives. And I think what fund manager incentives are definitely key to understanding the overall patterns over the years, in my view. So, for example, when sustainable funds were very popular, so before 2022, let's say, we do see more non-sustainable funds switching to being sustainable. It's consistent with both they believing that that is a financially better strategy because you are including this material information to your investment, as well as this is going to be a good marketing strategy, or it would be an effective marketing strategy. So, it's sort of good in both ways. And you do see that huge growth. And we do see opposite trend from 22 to 23. Overall, sustainable fund sector experienced outflow in the US. And this is after the interest rate hikes, the war in Ukraine, and energy price volatility. And then suddenly defense and oil and gas, those stocks do better. So sustainable funds are financially doing less well. So we see that in actually the result I didn't show, but you can see in Sharpe ratios when there are good flows to sustainable funds, that's when the Sharpe ratios of sustainable funds are slightly better than benchmark funds, but that reverses starting in 22, 23. And so that I do agree that managers are definitely motivated to get flows. And as long as they believe that being financial or moral are better for their flows, then unless they themselves have non-financial motivation, they are on a mission, they might choose to not run an impact fund. They might choose to run financial or moral fund instead. Just want to add one more thing. Like, I think you're also getting at sort of quiet ESG funds. They don't want to say they're ESG, especially after the political backlash. It's very, very severe in the US. So we capture those quiet ones that don't say loudly they're ESG in their fund name, because a lot of the conventional list is based on the names in the names of the funds. But we do capture a whole bunch of funds that are not on, for example, Morningstar list, but in the prospectus, if they are using ESG information in a meaningful way, regulation says you need to disclose that. So they do say that in the prospectus, but quietly, and the fund name doesn't really say they're sustainable. So that's very interesting. I think those funds do exist, and they probably don't want to repel financially motivated investors, who think that if you are saying loudly ESG, maybe your performance isn't good. So you do see that. I hope that
Okay.
answers your questions.
Yeah, definitely. Sophie, you want to move on?
Sure. First, thank you, Ayako, for sharing with us this interesting work and bringing to light what's behind sustainable investing. I think it's very, very interesting.
Thank you.
Well, when reading the paper and when hearing your talk, what I wanted to talk with you and maybe challenge a bit is the definition of impact. So I understand that the way we measure impact in this work is reduction of emission, and what could be the intending consequences of doing that in such a way that impact would then be having investment towards very brown firms, so that's where we could have the most hope for strong impact, because that's the one that are doing very, very worst than others. While on the same side, the one that are categorized as financial funds could be doing green from the beginning and keeping on doing green, but then they would not be accounted as impact fund. Do you see what I'm getting at? I'm wondering whether this is, you know, like maybe hiding some good or like firms doing well, while maybe like having incentives for investing in very brown firms. What do you think about that?
Yes, so a couple of things. Maybe I didn't have time. I now remember I didn't have time to go slowly on the slide. One is what they do. So these two columns here, you see my shared screen again, right?
Yeah.
The so we look at in sector tilts, what kind of sectors they hold a bigger weight in, versus within each sector, what kind of firms they hold. And what we find is that for financial fund, it's mostly they hold greener sectors. And also they hold better firms, but better firms in terms of ESG rating, but not in terms of emission. Whereas impact funds are holding browner sectors, but within the brown sector they hold relatively better performance. So think about, for example, utility. Utility, just by nature of their business, they have higher emissions. Whereas if you're a tech firm, aside from data centers, that's making them dirtier, but this is pre-data centers for AI. By nature of their business, they are very light on emissions. So it's easy for them to pledge zero emissions because their business doesn't require that much emissions. But for utilities, that's much, much harder. So if you are already holding companies that only have 39 emission intensity, the most that you can improve is very tiny. Whereas if you are starting with a browner sectors, I think it is fair to argue that it is more risk, because that's a heavier emission sector. You have a heavier regulatory risk and so forth. But you are generating a greater outcome. And I think that this result that impact funds are holding relatively better, so relatively green utility within a brown utility sector, that seems to be consistent with what they say they do. And for financial funds, if they are already buying, firm that pledged zero and they're already investing to do that, whether that financial fund holds that company or not, then I think, applying the impact, are you additive? Are you generating additive impact? We can't say that they have any impact. And excluding brown firms from your portfolio, again, that's not really generating impact. And so going to, you are pushing back on our financial funds really so bad. They're not bad in terms of what they claim to do. They are not claiming to reduce environmental harm. They are claiming to protect investors' value from deteriorating in the future. And consistent with that goal, we do not find any evidence that their investments actually is associated with better. If they're holding green and they're continuing to hold green, we should at least see zero change. But what we see instead is sort of, their best when they purchase and they kind of go worse. So that doesn't make them look good in our analysis.
Yeah, thanks very much for the clarification. I think if we have more time at the end, I may ask a question that links with SFDR and how Europe classifies fonts, like if we can make parallel.
Yes.
But Theo, I
Yes.
think I should leave the floor to Theo. Thank you, Yasuko. Yeah, Yuko.
You're
Thank
welcome.
you,
Thank you.
Professor, for your presentation. It was super interesting. I'm curious why impact funds attract the smallest share of capital. So I saw in your paper you talk about the highest retail expenses,
Yes.
maybe also lots of
Good catch.
information.
Yeah.
But is it so does these like retail expenses doesn't offset the will from investors for positive change? Is it, and so what would be the solution you'd find to attract more capital? Would it be better signaling from these impact funds? Would it be, yeah.
Yeah. So this is a really important question, and it's also a complicated question to answer because I
Mm,
think there are several things that are happening simultaneously that we would need to disentangle. So the
okay.
first question, it is a really big question, is what do people actually want? Like
Mm,
let's state that some people are not purely financially driven. Some people want to be good. And in philosophy, there are two ways of, defining to be good. One is consequentialism, the other is deontology. Consequentialism is more associated with impact. It's about you're doing good that's evaluated by what outcome you generated. So it's based on the results, right? And deontology is a different way of philosophy where it says you're actually good or bad based on some predefined principles. And in many ways, that's how we
mm,
operate, right? We should not
mm,
steal, we should not kill. Those are things that are just principles. And regardless of outcome. And so that is more aligned with moral funds. Moral funds exclude tobacco and
yeah.
gambling and increasingly fossil fuels, not because it would reduce emissions more, but because I don't want to be complicit. And
Mm,
so if it turns out that investors are more deontological than consequentialist, we may not be successful in growing impact funds because people may be happier to hold, like people like Sam may be happier to
yeah.
hold funds that say, we will never buy fossil fuel, we will never buy private prisons, so your conscience is clean. And there are some interesting experimental papers, some of them done by French authors, showing that in experiments, people exhibit more deontological moral
Mm,
preferences. And
mm,
so,
okay.
you can't change people's mind of,
Yeah.
their moral conscience. So that the jury is still out. I think we as economists are very consequentialist oriented because
Mm,
we are, just think that that's how we measure it. It's very result
yeah. I see
oriented.
what you mean. Yeah.
But whether or not the society as a whole behaves that way is an open question. I hope
Mm,
that we have a sort of diversity of people, and some
yeah.
people like Sam, but other people like Inger. If there is enough people in the Inger camp, then I think things like clear labels for impact funds to be able to be matched to people like Inger would be very, very helpful. And
Mm,
I see big problems in the US if we have no regulatory definition. So,
mm,
and there is a lot of skepticism and greenwashing. Um, yeah, the
yeah.
fear. So that
Mm,
may be preventing people from finding impact funds. And if they
yeah. I
found
see.
it, they might. And if they knew the difference between financial funds and impact funds, even
Yeah.
with a higher expense ratio, they might choose to go. But when they can't see the difference and all they see is they are both sustainable funds,
Yeah.
then
That's
it's
it. Yeah.
tempting to investing in a cheaper fee fund, in a better performing fund. And I think that would be also a potential story of what's going on. So
Yeah.
I hope
Okay.
I hope the latter, and because then
Yeah.
there could be
Yeah.
more that
Solutions.
we can do, yes, and policymakers can play a role.
Mm,
With
Yeah,
respect to
but
that, if I can,
Yes.
I had a small concern is the fact, not with your paper, but with the situation, the fact that you kind of need a machine learning tool to assess what funds are doing. So in a sense, that if I take one fund as an investor, I may have difficulties really understanding what they do. And so this kind of clear labeling is not there and say, well, you have to see behind what do they effectively do.
Right.
And I would be kind of skeptical that investors really do the due diligence on all their funds. So
Right.
that's a little bit concerning in a sense.
Yes. That's also, I mean, your concern is also verified by another recent working paper that used two subjects. One, I was actually in a subject, but so they survey a bunch of academics, and then they also survey and experiment with more general public to test their understanding of sustainable, say, funds as products. And what they find is that retail investors are much more, I guess, naive about the potential impact of just sort of generic green products, products that are just marketed as green. You put a label green and people think that, oh, this is going to generate positive impact. Whereas academics, of course, are much more discerning, so they can tell the difference. So machine learning is basically behaving like academics, or at least professionals, but the general retail investors cannot do the same, even if they're given the prospectus text. So what they need instead is a better regulated label. So that leads us to, Article 6, 8, 9, that kind of template. Can that be used? And that's something that I'm actively doing some work with my European colleagues.
And yeah, on that note, I'd be curious, compared to the EU way of doing things, how did you already have results on the difference with the US, or
Um,
in
It's a
terms of
little preliminary. Yeah, so we don't
yeah,
have a paper yet, but we look at the Article 8 funds and Article 9 funds. Article 8 funds are much, much larger in terms of the assets they manage than Article 9 funds. And Article 8 funds are still, a lot of it is financial, whereas Article 9 funds have a higher percentage of impact funds. So it definitely helps that the labels are there, but it's not as simple as all Article 9 funds are impact and all Article 8 funds are, do all the same thing. Within Article 8 funds, we still see heterogeneity. And so I guess what I would say is it's a very helpful step in the right direction. And I know that the EU is updating SFDR, so there will be more emphasis on impact. So what we study is the current version. The current version, there is definitely room for improvement, but let's keep improving it.
yeah.
And that's definitely a framework that I wish the US would also adopt.
What I see also, and then Sophie, maybe you have a concluding question. What I see is that things are changing in a sense. So things can change. Things has been done. My fear is that what has been done can be undone. Are you also looking at this kind of perspective, having this kind of chronological perspective? Is that at some point we're improving, but it may over time, due to some kind of policies put in place or things like that, be undone? And do you think this is something that we're observing, or that we may have this kind of ratchet effect? Is that we are at this stage and then we're going to keep at this stage and then maybe we can improve again and so on and so forth? So I have the feeling that we could go the other way, that some of your results may have this kind of stance when I look at financials, in a sense.
Yes, I think that just conceptually, financial fund goals are not really aligned with a converging to some kind of a fixed goal, right? Because their goal is not to achieve any kind of environmental collective goal. That is not their stated goal. Their stated goal is we take all these changes that are happening in the world as given, and we are just responding to it the best way we could to preserve the financial value of our portfolio. So it's a survivalist philosophy. It's not a let's collectively move towards a solution philosophy. And so, as long as financial funds are the dominant funds, it serves the purpose for people who want that survivalist fund, but it's not really adding to this collective, effectiveness of sustainable industry as a whole to nudge firms into permanent solutions. And that's a good example is just a change in the popularity of defense and energy with more and more geopolitical risk that those stocks are expected to perform very well. European defense stocks are expected to perform very well in a changing geopolitical landscape. If you are a non-financial sustainable fund, you have a more of a fixed commitment. If you're a moral fund, you're not gonna suddenly say like, well, weapon is good now because it's a more of a fixed moral stance. They are still going to exclude. But if you're a financial fund, that is not the principle. The principle is this a material financial risk or is it actually an opportunity? So if it becomes an opportunity, it is consistent with them to pursue those financial opportunities. So I can certainly see that reversal if A, the financial funds are dominant, and two, again, politically, we cannot coordinate a more permanent regulatory, sort of global level regulatory framework that sets incentives of fund managers permanently. And I think that is very critical right now because it's very difficult to coordinate that globally. And I do share your concern. But I think we need to keep raising those concerns so that we can not just sort of let the ball drop and we are not even watching that kind of situation. So I share your point.
Yeah, and if I may add, maybe not a concluding, but like one last word on that is that I think we're tackling two issues, right? We're tackling the issue of a market failure, the fact that there are some untransparent fund that needs labeling, that needs regulation, that needs proper monitoring. But we are also dealing with investment behavior that may evolve as well in the future. And that maybe with education and with more sensitivity to green technology could also be more attracted to those funds that will be hopefully benefiting from clear labels in the future. But I think we need also to still think about the other side of it, the investment behavior of investors.
Yes, yes. And that's a very good final point. I think I didn't have time to emphasize, but impact funds can do both invest in brown firms and turn it more green, and also invest in green solution firms. So those tend to be smaller, small cap, but more invention oriented, like patents and technology type of firms. And we do see that in some of our analysis. So those some solution focused impact funds could attract more of tech type of investors or venture capital type of investors. But the solution themselves need to be financially attractive for that to flow. So there are different type of impact investing, I should add. So I agree with you.
Yeah, but I think it's interesting as well to pick that point of what drives investment. What are investors interested in? Is it just financial, or are there other motives that are getting increasing importance? And I think it would be interesting to dig a bit further into that direction as well. I mean, I'm sure
Yes.
there are like research ongoing on that, but I would be curious to read more on that.
Yes. Completely agree.
Well, thank you very much to all of you. Yeah, Ayako, that was really insightful. Thank you very much, Theo and Sophie, for your questions. And I take this opportunity to simply close this year of the Future of Finance speaker series. We had lots of talks, and yours was pretty much the kind of merging between. We had lots of sustainable finance talks and also lots of machine learning talks. So in a sense, you're
Oh.
just bridging the two perspectives together. And
Oh,
so
that's
that's a very good
wonderful.
conclusion for a speaker series. Thanks a lot again. And well, wish you the very best for the future. And
Thank you very
well,
much, and congratulations on this wonderful series. I love to watch some of those recordings. Thank you.
thank you very much. Good
Thank
evening to
you.
everyone, and well, see you next year. Bye-bye.